Yeah, it's probably one that people are familiar with. So Kit McGrath, you'd see their education centres around. It's a tutoring business. Previously was a pure face-to-face business, running, I think, lessons of 6 students at a time. They were making a slow incursion into online, but the uptake was very slow. I think the perception from a lot of students and parents is that online learning, the outcomes aren't as strong as face-to-face. So people, weren't quite willing to take it on straight away. But of course, COVID hits and you're essentially forced into online learning, not just in schools, but with tutors as well. So luckily, they already had their online platform in place and was able to take advantage of that. And the overall business actually held up really well through COVID, considering the type of business it is. So it was one I referenced before, talking about XRF, where you talk about CapEx cycles and the way businesses invest. And I've sometimes said, when you have a larger business, and even take Catapult as an example before, Catapult's a few $100 million market cap and a good chunk of revenue. They have the capacity to put on 4, 5, 6 mil of new employees and can sort of, they have the size to be able to do that. For a Kit McGrath at 60 mil market cap, when you flesh out your executive team, upgrade your back-end platforms and go through this sort of CapEx investment cycle, even a $2-3 million investment completely wipes out all your reported profits. And so to do that's a big decision, and when to do that's an even bigger one. And they did that during COVID, where COVID hits. Their top line actually held up okay, but the growth stopped. They were previously growing about 15-20%. And of course, when COVID hits it, everyone sort of just paused. But the decision to then embark on an investment cycle, and they fleshed out with a chief technology officer, a chief product officer. They upgraded their back-end center management software, implemented like Salesforce as a marketing software and some online booking software. So they've done that during COVID. So the reported numbers, like I sort of was talking about before, took a real hit in that period. But now the benefits of that will play out. That scalable platform's now put in place. The COVID recovery, fingers crossed, we're on the way out. And after 2 years of disrupted learning, students are able to finally refocus back onto where they need to be. And so Kit's well positioned, I think, to really see some fantastic operating leverage over the next few years. So the two things they've done, and I think, again, it's a pivoting business model, which maybe makes it a little bit more difficult to analyze for people. But the first thing they've done is that pivot to online lessons. COVID accelerated that. I think that's now entrenched. I think they've sort of said 20 to 30% of lessons will stay online. It's actually persistently stayed up around 35, 40. So wait and see. Maybe it does make its way back down. But I think that's now entrenched, and people have seen you're able to do online lessons and maintain at least, enough to make it comparable to going in face-to-face. It also has the benefit, it opens up their addressable market. So you think about what Kit McGrath used to be. If you had a centre in Tamworth, it was very difficult to get anyone who wasn't in maybe a 25, 50 kilometre radius. It's a long way to travel for an hour tutoring lesson. With online lessons, it just broadens that whole basin of where you can attract students from. So that's the other big benefit they see. But the other key change to this business, and it's one that I always love to see a business do it, it's go from a franchisee model to a corporate model. So previously, the whole business was franchisee. Every Kit McGrath centre you walk past would be owned by a third-party franchisee. Kit McGrath would provide some back-end support of obviously the brand, and they'd collect 15 to 20% of the lesson fees for the services they provided. But over time, if you decide to do a corporate strategy, you can pick and choose which centres you want to bring into your corporate business. And so the centres that are doing well, the centres that have the, that maybe aren't optimized right, that if you were to purchase that, we can do some small things, change some things, and we know the strategies to optimize. And so you've seen it with a lot of retailers who have been franchiseed, and they slowly bring their best ones back in-house and capture that whole profit margin for themselves. And you leave the subscale or less optimized, in the case of Kit, usually your rural centres, to be franchisees, and you service them the way you always have. So this pivot to the corporate centres has meant they've had to bring in a lot of those costs up front. Like I said before, you've got to bring in an executive team, you've got to bring in a whole platform to be able to service, they've currently got 22 centres around Australia and the UK. But a lot of that's very scalable. Once you put those costs in place, the corporate center revenue can now scale over the top. So you go from capturing, like I said before, about 20% of your total lesson fee to now capturing the whole 100. So revenue growth's really strong. And now I think is where you'll see that profit growth really catch up with it, because you'll scale over that relatively fixed cost base in the background. So yeah, I think there's a lot to like about KIP. It to me feels a little bit where XRF was maybe back in 2017, 2018. You've had that investment period. You're now looking to leverage that and come out of it the other side and see that profit growth. And look, I think the other one as well is not only is it a good business, steady business, has historically been profitable, pays a dividend. I've sort of alluded to it. You've had 2 years of disrupted learning. And I think schools, governments, and even parents themselves, I think everyone acknowledges that it will be difficult for the current school system, the way it is, to just completely pick up that slack, and that in some form or fashion, tutoring will have to do some lifting. So governments, New South Wales and Victoria, have already put plans in place, and KIP McGrath has access to school-based programs. But the real big one that they are eyeing off is they've just started a little tiny beachhead into the US, and that's their expansion plan in the US is through the school system. So it's a very low risk way of expanding. They started with like 3 schools in Arizona. That's now up to, I think, 9. And they're just expanding as the school contracts roll in. So they'll win a contract with a school to provide some tutoring services for students. It means you scale up with your revenue without having to do like a lot of businesses, you might have to spend $3, $4, $5 million just establishing, trying to build a brand, trying to, essentially put a business in place before it even exists. So the ability to scale up like that with the schools, I think, is good. And it's under that KIP McGrath branding too. So that's the big one, is at some point, I think, when the time's right, they'll pivot away from just the schools and replicate their Australian business model, but they're able to do it in a very low risk way.
It's interesting. A lot of people don't know that before Storm took over as CEO, I believe it was, KIP McGrath shares traded for 2 cents. The business was in this real tough spot because it had these legacy franchise contracts. Some of them were like $12,000 a year, fixed fees going back to KIP McGrath. And obviously, as the franchisees did better and demanded more of KIP, they were in a tough spot where they had to kind of unwind the franchise deals. And they're also like you said, they're repurchasing a lot of these territories, like in the UK, Scotland, etc. It's a really interesting news. I like it. I own shares, by the way, because I see it as kind of like there's 3 ways for them to grow. They've got the corporate centers, they can repurpose the franchisees, but then they've also got the US business as well. And I think there was a lot of criticism of them making that foray into the US with Tutorfly. But if you think about it, if you take a 3-year view, say, the acquisition makes a lot of sense because it's positioned between tutor and student. And like you said, the governments are focusing on schools and getting students to learn more and using tutors to do that. So it's kind of opportune time for them to make that foray. I thought it was really interesting. And yeah, I think under Storm's leadership, the business's execution has been pretty first rate. So pretty much first rate.
Yeah, I agree. And, it's always, I was actually chatting to someone this morning about this. You see it with different companies where you have a founder who's founded a business, decades ago. And when a family member or a son takes over, it can sometimes be an interesting dynamic. And KIP McGrath, when KIP ran it, obviously KIP McGrath is the name there. It was a much more conservative business. And I think over time, without disparaging KIP in any way, things sort of were done because that's the way they were done. And so when Storm shows up and has some ideas about where this business not only can go, but some sort of where it has to go. Like his background was in tech, and I think he knew the future of tutoring would be online. So luckily he began that pivot before COVID. And understanding as well, the relationship between the franchisees was an important one, but one where I think you're right. The power had shifted to the franchisees and they had to bring that back. And I think going the corporate way has done that. It's shown franchisees, we can do this ourselves. So come with us, but we're not going to allow ourselves to be beholden to you. So I agree. I think he's done a really fantastic job. The share price reflects that from where it's been the last few years. Don't get me wrong, but on a shorter time frame of call it maybe a couple of years post COVID, it's sort of languished, I think. And I think a part of that is that dynamic I was speaking before about the reported numbers has been a little bit lumpy through this period as Storm's gone through his investment phase. But and I'm sure you agree with me as a shareholder. It's the ability to be able to see through that and see, again, I'll come back to it. I call it that underlying earnings engine. And so if I think about where Kip McGrath was 2 years ago versus today, the reported numbers, it would look like it's either gone backwards or gone nowhere. But the potential of those earnings, I think, has dramatically increased. And it's just, to bring an agriculture analogy into it, you're planting your seeds, and it's when you choose to harvest them is the big question. And I think that timing is pretty soon. I think you'll see it in the corporate side, maybe not the second half 22, but maybe FY 23. But it's certainly one. I love those styles of investment where the numbers are a bit muddy, but the underlying business has dramatically improved and the share price doesn't reflect that. That's where I think patient investors can just buy, hold, and just wait for the numbers. They'll come eventually. And when they do, the share prices will respond.
Yeah, Storm McGrath recently bought some shares, further strengthening the alignment to shareholders. But again, just a note here for listeners, just be mindful of liquidity. Kip McGrath, the company, KME is the ticker code, can be a little bit illiquid. So just keep that in mind. It does pay a little handy dividend as well.